Hi, my name's Eric, and I'll be reading you selections from Barrons magazine for the issue date of May 12th of 2025. This recording is produced by the Audible Local Ledger, a reading service for people who are blind or print disabled. We'll start with Up and Down Wall Street. Warren Buffett is one of a kind, but he has brothers in arms by Andy Serwer. May has started off as a momentous month, with milestones, expected or otherwise, coming and going nearly every day. Refreshingly, many of these occurrences aren't coming out of Washington. Sorry, Elon. Instead, these are narratives tied to larger-than-life, iconoclastic business leaders who've made their careers out of upsetting the status quo, going their own way, and even helping out the little guy. Firework number one is Warren Buffett's retirement bombshell. There won't be another Warren, says Seth Klarman, CEO and portfolio manager of value-focused hedge fund Bowpost. Warren could remind people that through thick and thin you should try to hold on and that America is a great place to invest. There's more here, though, than just Buffett exiting the stage, including a shared birth date of storied rival firms and the passing of the godfather of shareholder activism. By the latter, I'm referring to Robert Augustus Gardner Monks, whose obituary notes that his family line was intertwined with prominent Boston clans such as Peabody, Lowell, and Gardner. But Monks was best known as the founder of Institutional Shareholder Services, and while some take issue with what ISS has become, it ushered in a new sensibility of holding CEOs and companies accountable. Did you miss celebrating the 50th anniversary of May Day this year? We're referring to May 1st, 1975, when the New York Stock Exchange eliminated fixed-rate broker commissions. Traditional broker-dealers predicted the apocalypse. According to a Fairfield University white paper, Morgan Stanley chairman Robert Baldwin, a former Navy lieutenant, ominously labeled the coming deregulation as May Day, the international distress call, and the name stuck. For more on May Day, pick up a copy of The Last Days of the Club by Chris Wells. May Day didn't sink any Wall Street aircraft carriers like Morgan right away, but it did rock them. Deregulation also supercharged a minnow of a firm, Charles Schwab, which became one of the biggest success stories on the retail side of the business. Not long ago, founder Charles Schwab waxed about his firm's origins, which now has some $10 trillion in assets, in a short film. That was the magic day, May 1st, he said. That democratized the business and brought it open to anybody. If you got $100, you're in. We do consider this to be our 50-year anniversary, Schwab CEO Rick Wurster told me. I spoke to Chuck over the weekend and he shared some history about May Day. Then he told me about 3 or 4 ideas he thought we should be doing. Chuck's 87, but don't try to play golf against him. He'll take money off you. 50 years ago, Schwab described himself as a pariah who begged friends and family to invest in his company. Those who didn't pony up regretted it later on, he said with a chuckle. Today, Schwab is the company's second largest shareholder with 5.8% of its shares outstanding, worth some $8.9 billion. Who is Schwab's largest shareholder? Not surprisingly, index fund behemoth and competitor Vanguard Group, which coincidentally also celebrated its 50th anniversary on May 1st. Vanguard is the house that Jack Bogle built, another giant in the investing business. Bogle, who died in 2019 at age 89 and was the great proselytizer of indexing, not only created what became Vanguard, which also has $10 trillion in assets, but jump-started the entire indexing business. 2 memorable Bogleisms on indexing: don't look for the needle, buy that haystack, and don't just do something, stand there. Besides focusing on indexing, Bogle's other genius was structuring Vanguard as an investor-owned enterprise, kind of like a local food co-op, which produces no profits, but instead plows money back into the business and lowers fees, which has forced other fund companies to cut fees to compete. One analysis calculated that this Vanguard effect has saved investors over $1 trillion. I first met Bogle back in 1991. I thought Vanguard, then with $80 billion under management, had become a Goliath. Little did I know it was just the beginning, though what Bogle said to me might have given me a clue. The marketing strategy of my company just happens to be giving shareholders the best deal possible, he said, and it works wonderfully. Like Schwab, Bogle built an incredible business, helping Joe Investor. Warren Buffett was a big fan of Bogle's, and the feeling was mutual. Bogle complimented Buffett on his investing prowess and doing business the right way, while Buffett called out Bogle at a Berkshire Hathaway annual meeting and wrote about him as well. It might seem odd that Bogle and Buffett were so simpatico, given that what they espoused and practiced could be considered opposites. Bogle said picking stocks doesn't work, and Buffett did just that, and it did. While I suspect that Bogle would say Buffett was the exception that proved the rule, Buffett and Bogle do have at least one common cause or concern, that being fees, which Buffett wrote about in the 2016 Berkshire Annual Report. For decades, Jack has urged investors to invest in ultra-low-cost index funds. He has the satisfaction of knowing that he helped millions of investors realize far better returns on their savings than they otherwise would have earned, Buffett wrote. He's a hero to them and to me. Over the years, I've been asked often for investment advice. My regular recommendation has been a low-cost S&P 500 index fund. To their credit, my friends who possess only modest means have usually followed my suggestions. I believe, however, that none of the mega-rich individuals, institutions, or pension funds has followed that same advice when I've given it to them. Instead, these investors politely thank me for my thoughts and depart to listen to the siren song of a high-fee manager. Speaking of Buffett, let's return to May's biggest moment, his announcement at his shareholder meeting that he'll be stepping down as CEO at the end of the year. The timing was a surprise. Typical Warren Buffett, Ron Olson said to me. The Berkshire meeting was consequential for Olson, too, as he concluded his service on the Berkshire board after 28 years. A named partner of Munger, Tolles, and Olson, Charlie Munger being another one, Olson has acted almost as a consigliere to Buffett. Warren has always had so much respect for his shareholders and has been consistent with his behavior from the get-go, Olson said. I thought the announcement at the meeting was absolutely consistent with that. Instead of getting some cold public notice, the shareholders, many of whom had been with Berkshire and Warren for decades, were there for that moment. I got choked up, says Tom Gaynor, CEO of Markle Group, a holding company resembling a mini Berkshire Hathaway, and who has gone to every Berkshire meeting since 1991. It's as if you were at Yankee Stadium for the Lou Gehrig moment. Trying to simply sum up Buffett isn't easy, because perhaps the defining facet of the man is that he's both simple and complicated. When you think about the 10 things about Warren that made him special, you keep coming up with new ones, says Klarman. It's almost like peeling an onion. The deeper you go, the more layers you find. At my prompting, Klarman began to peel. The unique thing is probably the combination, he said. He ran the overall company and he was a great investor, which he was wired to do. His shareholder letters with financial pearls of wisdom, historical allusions and jokes, and a clarity of thinking that wasn't available anywhere else raised everybody's game. And then there's his patriotism. He also didn't do this so he could live an opulent life, Klarman said. He felt guilty about flying a net jet, and he owned the company. All he's really done with his money is give it away. In a way, he popularized buying stocks. People emulated that, and then some of them wanted to give money away like Warren. And then he formed the Giving Pledge to get other wealthy people to do philanthropy, and went internationally with it. He just lived by example, a really good example. For Gaynor, sports metaphors came to mind. Buffett had a 60-year run of double-digit compounding returns, he says. That's a record I don't think will be broken. It's like Coach John Wooden at UCLA when he won 10 NCAA basketball titles. Maybe unbreakable, but does that mean other coaches can't try? Same thing with Buffett. We should keep trying to learn from him. embracing rationality and acting with a long-term time horizon. To me, it's certainly the path and the way. Speaking of basketball, you may have missed that Greg Popovich, who's 76, coach of the National Basketball Association's San Antonio Spurs, also announced his retirement, same weekend as Buffett. As the NBA's all-time winningest coach with 5 league titles, Coach Pop is the Warren Buffett of pro basketball. Beyond just the winning, the Spurs have been incredibly consistent and a team-first, everyman's club. Popovich, who led the Spurs for nearly 30 years, the longest tenured head coach for any major sports league in the U.S., is plain-spoken, sometimes humorous and famous for not putting up with phonies. He helped put his medium-market city on the map. Sound familiar? In basketball, as in business, the vast majority of leaders are either just mediocre or worse. Only a tiny handful are truly exceptional decade after decade. This May, it's time to consider how truly special some of those outliers have been. Moving on in this week's Barrons to the Streetwise column by Jack Huff. Welcome to Tariff Purgatory. Don't expect it to last. I was raised Baptist, not Catholic, so there was no pope. The ecclesiastical nature and structure of our church seemed less top-down than casserole-based, going by the number of potlucks. Doctrinally, we were dunkers at baptisms, not sprinklers. More to the point, there was no mention of purgatory, either at Sunday school or the grown-up service. So, when I describe the current investing period as tariff purgatory, please don't hold me to theological precision. I mean only that we're in an intermediate stage between Liberation Day and whatever comes next. So far, it's going great, which feels comforting, which seems complacent, which sounds scary. So maybe it's going horribly when you think about it. I mean, shouldn't there be more punishment? Early last month, President Donald Trump announced crushing global tariffs and markets panicked. And then he instituted a tariff teaser rate of 10% for 90 days everywhere except China, which gets 145% for now. Markets felt better about that. Then the president posted online about how the Federal Reserve Chair's termination can't come soon enough. Markets wobbled because it wasn't clear whether he was referring to May of 2026 when Jerome Powell's time is up, or to more of a clear out your desk by noon because you didn't cut rates type of thing, which would be messy because presidents aren't supposed to be able to fire Fed chairs willy-nilly, and if we're stickling, rate cuts are decided by a 12-member committee. The president later said that he wasn't contemplating a firing, and markets liked that. Now the U.S. and the United Kingdom have announced a trade deal, or at least the underpinnings of a framework of agreeable deal elements. The 10% tariff is mostly sticking. The U.S. will also talk in Switzerland this weekend with China, whose policymakers, the president says, very much want to make a deal, which has Wall Street murmuring about those 145% tariffs coming down. But stocks haven't just trimmed their losses. They're about where they were before the tariffs were announced. I can think of 3 explanations. First, the president is right, and the U.S. is getting rich on tariffs. As an apolitical neo-401kist, I'm rooting for this one. It could be doubly rewarding because I plan to sue for at least a partial refund of the money I paid for that economics degree. Second, corporate America has such gravitational pull that policy changes bend to its will like light around a black hole. Earnings march endlessly higher. Climate change? That's just the sun starting to revolve around Microsoft. Happiness is a cap-weighted index fund. I like this option a lot more than the next one. Third, we've developed buy the dip-itis. It's a condition brought on by 4 decades of rising global trade, which boosted profits and held down U.S. prices, allowing interest rates to move much lower, which made stocks an even better deal, not to mention houses and cars. Symptoms of buy the dip-itis include excessive reliance on policymakers to act as a put, or something that pays off when stocks crash, by pulling various financial levers to get gains going again, or even just talking about pulling levers. Retail investors, quite different from institutional investors, remain invested in the market, and they've been buying the dip, says UBS Investment Bank Chief Strategist Banu Baweja. The data in the U.S. really hasn't deteriorated. First quarter growth was weak, but only because tariff front-running skewed the math. Earnings have been solid. People are legitimately saying, "Show me the white of the eyes of the slowdown and I might think about it," says Baweja. The problem is that the bite from higher tariffs on consumer budgets could still be coming. Assume that the UK agreement is soon repeated everywhere, holding tariffs at 10% except for China, where talks yield a cut to 60%. Even then, the hit to particularly domestic demand, less so to GDP, is going to be so large that the kind of earnings expectations folks have for the S&P 500 over the next 12 months, which is 11.2% growth, valued at 20.7 times forward earnings, just seems much too optimistic, says Baweja. He expects the S&P 500 to decline to 4,800 by the third quarter, 15% below recent levels. After that, look for a rebound, but expect lower returns in coming years than investors are used to. Forget about policy puts, given burdensome government debt levels, and rate cuts might not bring longer bond yields down much due to the supply of new treasuries, he says. If Baweja is right, plan on single-digit returns for a while, not double-digit ones, and only after we're well past tariff purgatory. Quite bluntly and simply, I'd be a seller into these rallies in the equity market, says Baweja, and by contrast, I'd be buying bonds on dips. Changing topics, a quick public service announcement: Sunday's Mother's Day, and for dads of young children, Wife's Day by proxy. Surely you have flowers ordered and restaurant reservations made. If you've forgotten, don't panic. I have an idea. Simply explain that while flowers remain the most popular Mother's Day purchase, cited by 74% of respondents in a survey from the National Retail Federation, and special outings are third at 61%, these categories haven't shown much growth in polling data going back to 2007. Indeed, greeting cards at 73% have been in decline. More on-trend categories include electronics, which have shot from 11% to 22%, and gift cards, up from 39% to 54%. Then explain that shoppers say they'll spend an average of $259.04 per person on Mother's Day this year. That's up exactly $5 from last year. But that mere average just won't do for such an extraordinary mom. So you've decided to match the 2023 high point of $274.02, delivered in the increasingly popular form of an e-commerce gift card, which has already been mailed. Of course, you don't want to say all this empty-handed. Be sure to print out the NRF survey results for supporting documentation. Or just hit Cracker Barrel. There are no reservations, and everyone loves Southern Fried Chicken. From the review and preview section of Barrons magazine, next step, oil at $50. Oil prices have been sliding and investors are bearish, but they may not be bearish enough. Despite a rally to $61 a barrel by Friday, U.S. benchmark West Texas Intermediate crude was still far off the January high of $78. We think WTI near $50 per barrel is likely the next key level on the current trajectory, wrote RBC Capital Market strategist Brian Lyson. Oil has supply and demand problems. OPEC and its allies are ramping up supply faster than expected, with daily production set to rise by nearly 1 million barrels by June from March. OPEC wants to regain market share from countries such as the U.S. and seems willing to endure lower prices to make it happen. And demand isn't rising fast enough to sop up extra supply. Global oil demand in April was flat with year-ago levels, says J.P. Morgan, and that means there's no easy way out of this slump. Most other sectors only face demand pressure. mostly from tariffs. And if they go away, those sectors could be in the clear. But energy could still face a glut. Bullish energy investors are hoping U.S. producers pull back drilling operations, leading to a fall in U.S. output and lifting prices. But so far, there are only moderate signs that's happening. At $50 a barrel, most companies can still make money on operating wells, but they'll almost certainly spend less on policies like stock buybacks, and few will be able to drill new wells profitably. Analysts' earnings expectations have come down, but they may still have room to fall. And that was reported or written by Avi Salzman. What happened last week in markets? On Monday, Brent crude fell to 4-year lows as OPEC Plus boosted output. The dollar slipped as Asian currencies, particularly the Taiwanese dollar, surged. President Donald Trump again urged the Federal Reserve to cut rates, but the Fed, as expected, stayed put while warning of rising risks. Stocks fell back and then rallied on news of U.S.-China talks and a U.S.-United Kingdom trade deal framework. On the week, the Dow Industrials fell 0.2%, the S&P 500 0.5%, and the Nasdaq Composite 0.3%. In companies last week, Warren Buffett, 94 years old, said he would step down as CEO of Berkshire Hathaway at year-end, handing the baton to Greg Abel. Trump said he'd slap 100% tariffs on foreign-made movies, but details were vague. The administration blocked Harvard from federal research grants. OpenAI retreated from its plan to become a for-profit company. Ford Motor pulled guidance, warned that tariffs would produce a $1.5 billion profit hit, and raised prices. Mattel said it was moving more production from China and planning to raise prices. Walt Disney announced a new theme park in Abu Dhabi. In deals last week, DoorDash agreed to acquire Deliveroo for $3.9 billion in cash. Bloomberg reported that OpenAI was buying AI-assisted coding tool Windsurf for $3 billion. 3G Capital said it would buy Skechers USA for $9.4 billion. Rite Aid entered Chapter 11 and began liquidating. And Sunoco said it was buying Canadian fuel distributor Parkland for $9.1 billion. This week, upcoming on Monday, May 12th, more than 450 S&P 500 companies have reported first quarter earnings, with nearly 80% beating earnings per share estimates and about 60% besting sales projections. Simon Property Group kicks off the week, reporting results on Monday, followed by Cisco Systems on Wednesday. Applied Materials, Deere, and Walmart announced their earnings on Thursday. On Tuesday, May 13th, the Bureau of Labor Statistics releases the Consumer Price Index for April. Economists forecast a 2.4% year-over-year increase. The core CPI, which strips out volatile food and energy prices, is expected to rise 2.8%. Both estimates would match the March data. The annual change in the March core CPI was the lowest in 4 years. On Thursday, May 15th, the Census Bureau reports retail sales data for April. Consumer spending is expected to be flat month over month after a 1.5% jump in March. And on Friday, May 16th, the University of Michigan releases its Consumer Sentiment Survey for May. April's 52.2 reading was the lowest since July of 2022, while consumers' year-ahead inflation expectations of 6.5% was the highest since 1981. From the numbers on the review and preview page, 76%, which is the percentage of 138 U.S. air traffic control systems deemed obsolete or potentially too difficult to maintain. 1,900, the number of suppliers from a dozen countries for Lockheed Martin's advanced F-35 fighter plane. 31%, percentage of Internal Revenue Service auditors who have taken buyouts or were recently fired. And 68%, that's the increase in trade between Russia and China from 2021 to 2024. Last year saw a record $245 billion. Our headline from Barrons of May 12th, 5 European stocks and 3 ETFs for trying times. Japan is too small, China's too totalitarian. Europe's cheap stocks and deep bond markets are the leading alternative to the U.S. by Brian Swint. When the going got tough in recent weeks, investors bought Europe. Don't expect that to change in the months ahead. Normally, the U.S. would be where fearful investors put their cash. It boasts the world's biggest economy and the deepest capital pools. And when trouble hits, investors know the Federal Reserve can step in to prevent a meltdown, something it did regularly from Black Monday 1987 all through the COVID-19 pandemic of 2020. Even when stocks were falling, the dollar and treasury prices have strengthened, providing ballast in tough times. President Donald Trump's trade wars and his attacks on Fed Chair Jerome Powell have undermined that stability. The policies caused stocks to drop in April, but they also caused the price of dollars and treasuries to slide, an indication that investors were looking elsewhere for safety. But where? Some places like Japan are too small, and China's too totalitarian, and that leaves Europe, with its cheap stocks, the potential for regulatory relaxation, and deep bond markets as the leading contender. Europe is the stability for cheap play, and we expect global investors to continue to fund European markets for as long as that holds, says Lewis Grant, a portfolio manager at Federated Hermes. It certainly passed April's test. For most of the month, U.S. stocks, bonds, and the dollar lost value simultaneously as equity volatility climbed to the highest level since the start of the pandemic. In Europe, by contrast, bond yields fell as prices rose, and stock moves were far less dramatic. In April, the S&P 500 index averaged a daily move of just over 3%. That's the highest since March of 2020. While the Stoxx Europe 600 averaged a daily range of just 2.2%. That relative calm is translated into better performance. The Europe index is up 4% so far this year, while the S&P 500 is down 5%. But that outperformance overlooks another key side effect of Europe's haven status, the strength of the euro. The common currency for 20 countries has gained more than 9% versus the dollar this year, its best start since the euro was created in 1999. And Deutsche Bank strategists expect the euro to keep appreciating through the end of the decade. The strong currency is translated into even better gains for U.S. investors who have made 14% in the Stoxx 600, 12% in France's CAC 40, and 23% in Germany's DAX. Fund flow data confirm that performance. During the week ended May 2nd, investors pulled $8.9 billion out of U.S. equity funds while putting $3.4 billion into European ones, according to Deutsche Bank strategists led by Parag Tate. Inflows into European government bonds were above average and rising, the report showed. Getting exposure to Europe can be as simple as buying an exchange-traded fund like the $23.7 billion Vanguard FTSE Europe, or the $7.8 billion iShares MSCI Eurozone, or the $5.9 billion iShares Core MSCI Europe. The funds have just done fine in 2025, gaining 17%, 20%, and 18% respectively. For that performance to continue, U.S. stocks can't crash. Equity markets on either side of the Atlantic are still subject to the same global investor sentiment, and the biggest companies need a strong global economy to drive their earnings, which come from multiple geographies. For European equities to go up, we need U.S. equities to go up as well, says Maximilian Ulier, head of European equity and cross-asset strategy at Deutsche Bank. If they do, we think European equities will outperform in most areas. The potential for a global slowdown could make resilient European stocks attractive, according to Morgan Stanley strategist Paul Walsh and his team. They screen for companies with marginal exposure to Trump administration policies, relatively high pricing power, little sensitivity to the economy, and low China and U.S. exposure, their definition of resilient. They came back with companies including Rheinmetall, SAP, Euronext, Swisscom, and E.ON that could be worth buying given the amount of uncertainty investors expect to face over the remainder of the year. While investor concerns around recession risks will ebb and flow, one thing is certain. Economic and policy uncertainty is high and likely to remain that way for the foreseeable future, Walsh writes. Many of the exposures represented are related to structural paradigm shifts and hence more sustainable. And for those seeking even more safety, there are always European bonds. Unlike U.S. Treasuries, German bonds are acting the way investors would expect them to when stocks sell off. Yields are falling and prices are rising. After Trump's Liberation Day tariff announcements, the yield on Germany's 10-year note fell to 2.4% from 2.7%, while the 10-year Treasury climbed from about 4% to 4.5%. Treasuries are not the only game in town, says Lawrence Gillum, a strategist at LPL Financial. European bond markets look a lot more attractive. They should remain safer, too. Our next story: Sphere is dazzling, but its stock is undervalued. James Dolan's futuristic Vegas arena has wowed concertgoers. Convincing investors has been tough, but there's lots of upside to consider. By Andrew Barry. Sphere Entertainment's Las Vegas arena draws raves from concertgoers thanks to a cutting-edge sound system and top-flight acts. Its shares could soon attract an audience of their own. But the stock, now trading around $33, is no Wall Street favorite. It's down 17% this year, and it trades for 35% less than its early 2024 high of $51. The bull case for Sphere focuses on earnings from its Vegas arena, a second to be built in Abu Dhabi, and other possible spheres around the world. Investors are paying little for that potential. Sphere Entertainment carries a market value of just $1.2 billion and net debt of $350 million. It's valued at a fraction of the $2.3 billion it took to build the Las Vegas Sphere, and for half of its book value. John Rogers, Jr., founder and chief investment officer at Ariel Investments, recently said Sphere Entertainment was trading for about a 50% discount to his estimate of net asset value. Wolf Research analyst Peter Supino agrees. He called Sphere shockingly undervalued in a report after an April debt restructuring deal. For around $1 billion, investors can own what could be a global network of differentiated properties, he said. The Sphere Entertainment story is complicated. It's CEO James Dolan's baby, an odd pairing of concert arena and regional sports network, reflecting a decision to merge MSG Networks with Sphere Entertainment in 2022 to provide earnings as the arena construction continued. To make matters worse, Wall Street applies a Dolan discount to the three companies controlled by New York's Dolan family: Sphere Entertainment, the New York Knicks and Rangers owner Madison Square Garden Sports, and Madison Square Garden Entertainment, which owns Manhattan's MSG Arena. That reflects concerns that the Dolans will prioritize control over what's best for all shareholders. MSG Sports, for instance, is valued at half the estimated value of the two teams because the Dolans are viewed as unlikely to sell. James Dolan laid out his strategy on the company's earnings conference call this past Thursday. It's all about growth and our ability to take a great product and expand it across the globe, Dolan said. He added that the company maximizes Vegas Sphere revenue by using it 365 days a year with multiple events during the day. The initial Sphere discount wasn't unreasonable. MSG Networks, a regional network that carries Knicks and Rangers games, has seen earnings drop amid cord cutting and is viewed as an albatross for Sphere. The company had too much net debt, around $850 million after cash is stripped out. That weighed on the stock. Sphere negotiated for 6 months with a bank group holding some $800 million of MSG Networks debt, emboldened because the debt was non-recourse to Sphere, meaning the parent wasn't on the hook for it. In a deal with the banks, Sphere cut its debt by over $500 million. MSG Networks also got relief from MSG Sports from lower annual payments for broadcast rights. Without a mountain of debt, we believe that MSGN will be sold, merged, or split out of Sphere, Supino wrote. Sphere has potential. The Vegas Sphere makes money in 3 ways: concerts, advertising on its distinctive exosphere, and original programming, notably Postcard from Earth, a 50-minute nature-oriented production that made its debut in 2023 and takes advantage of the arena's sound system. Tickets can cost more than $100, and Sphere is hoping that 2 new productions, an enhanced version of the classic Wizard of Oz film and From the Edge, based on extreme sports, will draw viewers to the Vegas arena. The productions are more lucrative because of profit-sharing splits with musical acts. The Wizard of Oz will debut this summer, and From the Edge in 2026. Ariel's Rogers told a recent Gabelli Fund's investment conference that viewers will feel like they're in the cyclone with Dorothy. The Abu Dhabi Arena is a key part of the company's future. Unlike the Vegas Sphere, development partners would pay to build new arenas, including Abu Dhabi, with Sphere getting high-margin royalty and other income. Sphere is also developing 5,000-seat prototypes, smaller than the Vegas Sphere, which seats 17,600. Supino has an outperform rating on the stock and a price target of $65, roughly double the current price. Supino now values the Las Vegas Sphere at $1 billion, or 15 times projected 2026 free cash flow. The Abu Dhabi Arena at $750 million, $200 million for MSG Networks, plus the value of future global spheres, for a total of more than $2 billion. That's twice Sphere's current value. Why the depressed stock and valuation? Complexity and profitability are high on the list. Sphere isn't profitable based on generally accepted accounting principles. It has little free cash flow, lost over $2 a share in the first quarter, and it's projected to lose $7 a share in 2025, partially due to heavy non-cash depreciation from the Sphere Arena. The company has frustrated investors by not providing guidance or an indication of potential Vegas Sphere profits. It hasn't provided a completion date for the Abu Dhabi Sphere. Still, Sphere is priced for bad news when a lot can go right. New spheres will be built, higher profits in Vegas could materialize, and MSGN could be spun off, and a company sale is possible. Many buyers could surface, including Live Nation Entertainment, the U.S.'s biggest concert promoter and Ticketmaster owner. A sale might be a long shot, but the stock's cheap enough that there doesn't need to be a deal for it to work. James Dolan seems to think so. He took nearly all of his pay, $18 million last year, in stock. The next headline, how tariffs blindsided small U.S. businesses. Small companies lacked the resources to handle rising tariff costs, disrupted supply chains, and deep uncertainties. Here are 4 survival stories by Reshma Kapadia. A wave of earnings warnings in recent days illustrates the potential damage to publicly held American companies from Trump administration tariffs. But for many small businesses, the outlook is much more dire. Small businesses are in survival mode, often without the cushion and resources of bigger companies to navigate a rapidly changing global trading system. Chris Pence, co-founder of tableware maker Hond, started the year upbeat. Hond planned to show its pottery at a trade show and begin exporting to Canada. But instead of playing offense, the Burlington, North Carolina company's ratcheting down growth plans and cutting costs after the Trump administration's spate of tariffs and the resulting fallout. We feel blindsided, says Pence. It's hard to identify where the opportunities lie. It's like we're getting hit with a sock full of quarters in the dark. Distributors worried about tariffs on Canada upended Han's export plans for the year, forcing it to rein in growth expectations. Han makes its products in the U.S. but sources premium porcelain from Spain and the U.K. for tableware that it sells to the hospitality industry and elsewhere. That critical input is at risk of becoming much more expensive amid the volley of tariffs and harder to obtain. Orders that would arrive in 1 to 2 weeks in the past are now taking as many as 8 weeks. Americans live paycheck to paycheck. Small businesses live opportunity to opportunity, Pence says. He says he had to cut wages and 10% of his 24-person staff, something he managed to avoid during the pandemic. Tariffs have ratcheted higher under the Trump administration across a spate of countries. While President Donald Trump put a pause on sweeping country-specific tariffs on April 9th to try to negotiate deals, a host of others, including tariffs of 145% on all Chinese imports, remain in place, and additional sector-oriented tariffs are still expected. For every mega-cap company like Apple warning of a $900 million hit from tariffs in its June quarter, or Ford Motor projecting a $1.5 billion blow this year, there are smaller businesses without the megaphones of high-profile CEOs and lobbyists pushing for exemptions or bailouts, or teams of executives gaming out trade scenarios. As companies of all sizes warn of disrupted supply chains and empty store shelves, analysts say pressure is building inside the White House. The question is whether de-escalation with China or promised trade agreements will be quick or substantial enough to address the uncertainty for small businesses. Voices in the Trump administration in recent days have indicated that the current tariff war is unsustainable, and they signaled a desire to de-escalate the battle with China. They also suggested that agreements with other countries are forthcoming. Some 235,000 small businesses import goods or materials representing a third of the total value of U.S. imports, according to the Chamber of Commerce. And 40% of those are like Han, building their products in the U.S. but requiring raw material or other inputs from abroad. Neil Bradley, Chief Policy Officer at the U.S. Chamber of Commerce, is worried about the ability of some small businesses to survive. If you were large, you may have had leverage and the wherewithal to import a lot of stuff to create inventory ahead of tariffs coming, Bradley said at a small business event that was hosted by the Chamber of Commerce. Often they, meaning small businesses, don't have the reserves to eat the increased cost of tariffs, so they're counting on the ability to pass it on to their customers, and sometimes that's hard to do. The disruption and confusion from the biggest trade upheaval in decades is one reason that the Chamber of Commerce pushed the administration to consider an automatic exclusion for small businesses from tariffs, so they don't have to worry whether a deal is struck and what tariff level it will come in at, Bradley said. In a White House statement for Small Business Week, Trump said that his administration is cutting red tape, keeping taxes low, promoting fair and reciprocal trade practices, and fighting for hardworking Americans. In an interview with Fox Business, Small Business Administration Chief Kelly Loeffler said she was seeing Trump's agenda benefiting small businesses. She said that Trump was supercharging the return to Made in America, and the agency was seeing a tremendous increase in loan volumes. Small businesses are spring-loaded, she said. We still have tax cuts and deregulation to come, a tremendous boost to small businesses. But any relief is already late for some businesses. Jimmy Zolo, who co-founded apparel maker Joe and Bella in Chicago after helping care for his elderly mother, is battling the trade uncertainty. The company manufactures its adaptive clothing for disabled and older adults in China. The clothing, which includes pants and shirts with magnets to make dressing easier, should fall under a 1972 tariff exemption for goods made for disabled individuals. Yet Zolo finds himself in a web of confusion among customs brokers about whether his goods are subject to tariffs and how the levies could affect timing of processing orders. That uncertainty has kept him from buying more inventory for the crucial fourth quarter, which accounts for about half of his sales. By early third quarter, we need to have full clarity on how many orders to place and at what scale, Zolo says. Making the goods elsewhere isn't feasible, in part because 90% of the world's magnets are mined in China. The rush to diversify is creating capacity issues in alternative destinations, such as Vietnam, with some manufacturers turning away companies. Zolo worries that the disruptions and trade tensions generally could jeopardize his relationship with Chinese manufacturing partners. He says he knows other brands that have lost their partners or that have been approached by larger Chinese manufacturers looking to buy them. Even those who made preparations for a world of U.S.-China friction and tariffs are scrambling. Abby Perry, who runs Abby's Garden Parties in Zionsville, Indiana, tried to build inventory of a specific type of closed container she uses for terrarium building events such as birthday parties. Worried about a possible price increase due to tariffs, she bought about 200 containers in late March, the most that her budget would allow. And when she went to replenish her supply in late April, she was hit with sticker shock. The 50 containers cost $200, but when she went to check out, she also found a nearly $150 shipping fee and $350 import charge. In the fine print, it said the import cost was subject to change. That uncertainty for me is too much. As a small business, I need to know that if I buy something, it's not going to be 200% higher by the time it ships, Perry says. With just one part-time employee, Perry has had to spend hours scouring online and offline stores for alternative containers. Rick Woldenberg, chief executive of educational toy maker Learning Resources, started diversifying his supply chain, about 15% of his products, from China to Vietnam and India 2 years ago. When the Trump administration announced its first set of tariffs, he slashed costs. But his scenario planning didn't include what he calls a synchronized catastrophe, where the rules are being changed for just about everyone. We built our supply chain over 40 years, and they cut the legs out in 7 days and gave me 0 minutes notice, says Woldenberg, who filed a suit against the Trump administration, arguing that the tariffs are unlawful. The Department of Justice asked the court to deny plaintiffs' motion for a preliminary injunction, citing, among other reasons, the jurisdiction of the court over international trade issues and the president's constitutional authority to impose tariffs under the International Emergency Economic Powers Act. The hearing is set for late May. As the tariffs hit, Woldenberg had his team again explored the possibility of making products in the U.S., digging into the idea of a 3D printing farm. But that would fall short of the scale needed for the business and send costs flying. Products that sell for $23 would need to be priced closer to $600. Moving more production elsewhere in Asia is also difficult. Many countries are unable to match the ecosystem built up over decades in China. A combination of skills, broader production capabilities, and access to components and transportation. And then there's the uncertainty over whether alternative destinations could also be hit with tariffs. Woldenberg says his company is trying to deepen its relationships in Vietnam and India, shifting hundreds of items to these markets and having the number of new products slated for next year from the typical 200 to 250. We are evacuating from China, he says. As far as we're concerned, production there is over. Doesn't matter what happens with a trade deal because I don't have time to wait and see how it turns out. I'm rolling the dice like I never have in my life. We'll close with the cover story, The New War Machines. Defense stocks are under fire. Traditional contractors, L3 Harris and Northrop, look like winners. Upstarts like AeroVironment, Karman, and Kratos are worth watching as well, by Al Rote. Disruption has come to the military-industrial complex. Defense stocks have lost the first battle, but they can still win the war. The past year has been a trying one for defense companies like Northrop Grumman, Lockheed Martin, and General Dynamics. as they fight disruption on two fronts. On the first front, the way wars are fought has changed, from the Russia-Ukraine conflict, where cheap drones have been weaponized to make up for lack of manpower and equipment, to the Middle East, where unmanned aerial vehicles have become essential combat tools for offensive purposes, reconnaissance, and targeting. It's a world where the $13 billion USS Gerald R. Ford, a nuclear-powered aircraft carrier that took 8 years to build, can be threatened by hypersonic missiles or autonomous subs and torpedoes costing mere millions. When cheap technology can make any weapon obsolete, long development times and billion-dollar price tags feel like luxuries no one can afford. If that weren't enough, defense companies are fighting on the home front too. Every new administration brings change, but the early days of the Trump administration have been more chaotic than usual. Department of Defense Secretary Pete Hegseth was barely confirmed by the Senate. Vice President J.D. Vance had to cast the deciding vote. When President Donald Trump fired Chairman of the Joint Chiefs of Staff C.Q. Brown, a very unusual step for an incoming president. With leadership in turmoil and a series of Elon Musk tweets arguing that new artificial intelligence-enhanced technology from upstarts such as Palantir Technologies and Anduril Industries should replace long-established military programs, it's little wonder that shares of Lockheed, Northrop, General Dynamics, and L3 Harris Technologies have slumped some 10% on average since the election, while shedding about $25 billion in market value. On the surface, the defense sector looks like it could be fighting a rearguard action for years to come. But looks can be deceiving. Disruptive change can't always be accomplished by existing players, and traditional defense contractors have a history of being able to deliver new weapons when needed. That should be the case even as the military shifts toward cheaper, smarter, AI-enhanced weaponry. At the same time, there'll still be a need for more traditional jets, boats, tanks, and missile systems that only the likes of Northrop and Lockheed can provide. With shares of defense prime contractors' stocks trading lower valuations than they did when the 2011 Budget Control Act threatened to slash military spending, now seems like a good time to bet that defense stocks won't fade away but emerge stronger from the skirmish. There's no Amazon.com and Barnes & Noble analogy, says Capital Alpha Partners analyst Byron Callan of the clash between disruptors and traditional companies. It's Amazon and Walmart. War always changes. Arrows give way to bullets, wood to iron, propellers to jets. Every new discovery is then iterated on and perfected until new technologies emerge and the process starts again. That's true now more than ever. Battlefields around the world have become laboratories for new weapons and strategies. In early May, Ukraine claimed to have shot down 2 Russian fighter jets with seaborne drones. The U.S. has been using its Maven AI system to hunt for Houthi targets, which had resorted to shooting down drones and missiles from Yemen with RTX-made Patriot missiles. Patriots are effective, but firing the million-dollar missiles at cheap drones is like exchanging a queen for a pawn. When the enemy has cheap weapons at their disposal, bringing down cost matters a lot. Much of the current procurement system is based on cost-plus contracts, essentially agreements that provide weapons producers with guaranteed profit margin. There's a logic to the system. There's no commercial market for jet fighters, for example, and few alternatives for the Pentagon if it isn't happy with one price. It ensures the military has what it needs, usually when it needs it. The potential problem, though, is obvious. Cost-plus provides a tacit incentive to inflate costs throughout the supply chain. A hard bid system where companies offer a price and then deliver the goods would make more sense. It might not work for aircraft carriers or fighter jets, but it can work for drones and munitions. The Pentagon is aware of the need to balance cost and performance. The U.S. military already uses dozens of unmanned systems on land, sea, and air, with more on the way. Drone advancements are why the Army killed the more expensive Future Attack Reconnaissance Aircraft program in 2024. Trump also endorsed Unmanned Collaborative Combat Aircraft, or CCAs, where one pilot might command 10 pilotless planes, while simultaneously awarding a sixth-generation manned fighter jet program to Boeing. Defense contractors have proven that they can act quickly and cheaply when pressed. During the first Gulf War, traditional defense contractors in the U.S. military designed, tested, and deployed a bunker buster called the GBU-28, capable of destroying Saddam Hussein's facilities buried 150 feet underground in less than a month. It helped to end the war. That's the speed at which things can happen when requirements and motivations align. The ability to align, however, has been lacking in the Trump administration. The president has fired inspectors general who are charged with ensuring that the government gets value for its money, and infighting has led to threats of polygraph tests for senior officials suspected of leaking. The Pentagon declined to comment on the reports. Trump's goal, however, is clear. He wants a stronger, more efficient military apparatus that can rapidly deploy new technology, ensuring America's military dominance in the face of growing threats from China and elsewhere. Barring an outbreak of world peace, the U.S. will be spending roughly 3% of gross domestic product on national security for years to come. Trump's initial request for fiscal year 26 is just north of $1 trillion up, 13% from 2025. The $113 billion year-over-year increase includes money to expand shipbuilding, fund the F-47 next-generation fighter jet, modernize America's nuclear arsenal, and develop Trump's Golden Dome missile defense shield. It's only a proposal, but it's a bullish sign. The devil, of course, will be in the details. The risk is more money that goes to startups and less to the big defense companies. One to watch is privately held Anduril, which was founded in 2017 to do to defense prime contractors what SpaceX did to the space launch industry. Anduril is still small, but it's growing. Contract awards total some $4 billion. It's also worth some $30 billion in private markets. L3Harris has a market value of about $41 billion and a current backlog north of $33 billion. Still, says Callan, Anduril is placing a lot of different bets across a lot of different market segments, and that's a departure from other startups. Anduril isn't the only defense upstart worth watching, so we're privately held Mach Industries, which works on low-cost strike drones, and Shield AI, which develops AI for military hardware. Publicly traded AeroVironment, Carmen Holdings, and Kratos Defense and Security Solutions are small-cap stocks working on small munitions and drone technology. The presence of these upstarts could push the legacy defense companies to move faster and work more cheaply. And with that, we've come to the end of our reading of Barrons Magazine for Monday, May 12th of 2025. This is your reader, Eric, saying be well, be safe, look after each other. Bye for now.